All right, let's just dive right into this explainer. Look, if you're living abroad right now and you've got any money tied up in India, I'm talking an FD, a mutual fund, some property, or literally just a savings account, you might actually owe the Indian government money. And here's the kicker. You've only got 11 days left to sort this out before that July 31st deadline hits for the 2026 filing year. Every single year, millions of non-resident Indians make the exact same incredibly costly mistake. They just kind of assume, hey, I live abroad, Indian tax rules don't apply to me anymore, right? Well, they're wrong. So today, we're going to clear up exactly who actually needs to file, which forms you absolutely have to use, and how to dodge some pretty severe penalties. See that massive 30% right there? Yeah, that's the standard tax deducted at source, or TDS, that often gets skimmed right off the top of your NRO accounts. The reality is, the government might already be sitting on a huge chunk of your cash, and honestly, a lot of NRIs have absolutely no idea they're bleeding money like this. But before we get into the nuts and bolts of actually getting that money back, I want to plant a little seed. Later in this explainer, I'm going to reveal this massive, seriously under-the-radar tax benefit called the RNOR status. It's a total game changer that could legally save returning NRIs literally lakhs in taxes. So definitely stick with me on this one. Section 1, determining your residency status. So getting this whole thing right starts with figuring out exactly who you are in the eyes of the Income Tax Act for the 2025-26 financial year. Basically, to be treated as an NRI for tax purposes, you have to hit one of two day count options. Option A is pretty straightforward. You spent fewer than 182 days in India during the financial year. Or there's option B. You spent fewer than 60 days in India this year and fewer than 365 days over the previous 4 years combined. If you hit either of those, boom, you're officially classified as a non-resident Indian, and all these special rules apply to you. Okay. Let's circle back to that RNOR status I teased a minute ago. It stands for resident, but not ordinarily resident. Basically, it's this sweet transitional status for returning NRIs that usually lasts about 2 to 3 years after you move back to India. And the best part? During this window, you are taxed only on your India-sourced income, not your global income. It's a huge confusion zone, honestly, where like 90% of returning NRIs end up accidentally overpaying because they just jump straight into filing as full residents. Seriously, don't be one of them. Section 2, taxable versus tax-free income. Now that we've got your status locked down, let's categorize exactly what the Indian government actually can and cannot tax. There's a really critical difference in how your different bank accounts are treated here. If you're keeping your funds in an NRO account, well, that interest is fully taxable in India, period. End of story. But on the flip side, any interest generated in your NRE or FCNR deposits, that is 100% exempt from tax, completely tax-free. But listen, aside from that NRO interest, you also have to report these specific income sources if they happen in India. We're talking rental income from an Indian property, capital gains from selling Indian real estate or stocks, any salary you earned while physically visiting India, and pensions received there. And get this, even if you're living it up in a zero-tax country like the UAE, if the income was generated on Indian soil, it is absolutely taxable by India. And speaking of capital gains, if you happen to sell any Indian mutual funds or stocks, these new post-budget capital gains rates apply directly to you. Short-term capital gains on listed equity, that's sitting at 20%. Long-term is at 12.5% for anything above 1.25 lakh rupees, and that's without indexation. Honestly, your broker has probably already deducted this TDS right at the source. Moving right along to Section 3, cracking TDS and refunds. Let's dive straight into the absolute biggest pain point for NRIs, the dreaded TDS trap, and, of course, how you actually escape it. Okay, the absolutely crucial thing to remember here is this specific number, 2.5 lakh rupees. That basic exemption limit, it actually applies to you as an NRI. It's wild how many NRIs just don't know this. If your total Indian income is below that threshold, you literally owe zero tax.
But here is exactly where things go off the rails. So many NRIs wrongly assume that once a bank or a broker deducts TDS, they're completely done. They think, oh, TDS is paid, I'm compliant. No way. It absolutely doesn't work like that. If your income is under that 2.5 lakh mark, or your actual tax liability is lower than that massive 30% they took from your NRO account, you have to file. Thousands of you are literally leaving your own money on the table just because you aren't filing an ITR to claim your refund.
Section 4. DTAA and Form 67 explained. All right, let's get into a critical protective measure that causes a ton of very legitimate confusion, the Double Taxation Avoidance Agreement. So, DTAA is basically there to ensure you don't get penalized by paying taxes in both India and your country of residence on the exact same income. India actually has these agreements with over 90 countries. And hey, even if you live in the UAE where there's no personal income tax, this treaty is still incredibly relevant because it specifically assigns the taxing rights to just one country for certain types of income. But claiming this credit means you have to follow a very strict sequential checklist. Step 1, you pay tax abroad on the income that's also taxable in India. Step 2, you file Form 67. And Step 3, you go ahead and file your income tax return in India. Now, I really need to highlight the harsh reality of that second step. If you forget to file Form 67 on or before the due date of your ITR, the tax department will outright deny your foreign tax credit, no exceptions. Skipping it is just a massive trap that literally forces you to pay your taxes twice. Section 5. Avoid costly filing mistakes. We're in the final stretch now, folks, so let's rapidly break down the absolute most dangerous pitfalls you need to steer clear of before that July 31st deadline. First up, using the wrong form. Guys, this is an instant rejection. You have to use ITR 2 if you've got capital gains, or ITR 3 if you have business income. Do not use ITR 1, also known as Sahaj. That form is completely banned for NRIs under any circumstances whatsoever. Let's quickly hit some other frequent pitfalls. Treating your NRO interest as tax-exempt, huge mistake. But honestly, the biggest one is forgetting to update your residential status in your bank and brokerage accounts. If you don't update this, they're going to apply entirely wrong TDS rates. Oh, and don't ignore capital gains from mutual fund SIPs you might have started years ago when you were still a resident. Finally, yeah, e-filing is online, but assuming a CA back in your home country can just handle the weird nuances of an Indian ITR without working with an Indian professional, that almost always leads to a total disaster. Now, what happens if you just decide not to file, or you let it slip your mind? Well, you're looking at a 5,000 rupee late fee right out of the gate. Sure, it drops to 1,000 rupees if your income is below 5 lakhs, but on top of that, you're going to get hit with a pretty punishing 1% monthly interest on any tax you owe. Ouch. So, as we wrap up this explainer, I really want you to ask yourself something. Are you leaving your hard-earned money sitting on the table? Have you actually checked to see if you're owed a massive TDS refund, or if you can leverage that incredible RNOR status? The clock is ticking down to July 31st. But honestly, looking beyond this one deadline, it begs a much bigger question. As your global wealth grows, is your cross-border tax strategy actually protecting your assets? Or is it just quietly draining them without you even noticing?